Okay, welcome today. It's nice to see so many people here. It's a great pleasure to be able to introduce Bob Treue, who's somebody who has had a relationship with Man in various forms for about 10 years. We'll tell you more about that. But he was one of the people who came to Man, one of the first investors that I saw who'd actually established a real track record based on trading their own capital. And Man was one of the early providers of investment to Bob, who has, over the last 10 years, grown the Barnegat Fund into something that's got nearly $500 million under management now. And he's going to be telling us about the type of trading they do and how they were very successful at exploiting the largest arbitrage ever. Okay, thank you very much.
So I'm happy, anytime you guys have questions, feel free to interrupt. I'm happy to talk about anything, any part of the fund management business. So it's all very open. Feel free anytime you want. But this whole thing started. I began to work at the Man offices back in '99 and 2000, and then my fund launched in January 2001 with Man as one of the investors. So fast forward 10 years, one of the guys I knew at Man saw these FT articles. There was a series of articles. A group of academics wrote this paper called The Largest Arbitrage Ever. And they wrote it this year about an arbitrage in 2008. So just by lucky break, the journalist who was talking to the academics about this piece happened to sit next to a journalist who knew about Barnegat and that we had captured this trade in 2008. So they got together. And so FT wrote a series of articles here about the arbitrage and about Barnegat. So from that, Tim Wong, who I'd known from 10 years ago, said, hey, Bob, why don't you come over and speak to Man and to the Oxford gang about that trade? And so, back when I launched the fund, I've always been grateful that Man took a chance on me when very few other people would. So I was happy to come over and talk about it. But so here, if you ever want to look up the articles, you can see everything. So the trade that they referred to that we captured, it's very simple. It's shockingly simple in the sense. So tips are like UK linkers. And I'm going to try, if I ever use any lingo or financial terms that don't make sense, tips are Treasury inflation protected securities. So they pay you a real yield plus whatever inflation turns out to be in the US. And they're issued by the US government. So let's say right now you can get like 1.5% for 15 years or 20 years. Sorry, it's even less than that. It's like 1.1%. Plus whatever inflation turns out in the US. Treasuries are just like gilts, straight, get a 4% coupon or 3% coupon, nothing fancy, just pays that each year. And then inflation swaps are an exchange of a fixed rate for whatever inflation turns out to be. And now, the way those work, so let's say that you and I were to bet on Manchester United Chelsea. We don't exchange any money today, just when the game is played, then we settle up and pay off the bet. So swaps are like that in a sense. It doesn't cost any money today, we just have an exchange. We say, okay, I'm going to exchange 1.5% with you for the next 10 years. You pay me inflation, whatever that turns out to be, I'll pay you 1.5% every year. So it's just, that's how a swap works, so no money up front. So now here is the trade. The academic paper is 50 pages. It's a fantastic paper. It lays out in great minutia all the details of the trade. But in the end, it just comes down to this one page. So the thing that we did was we bought, the example I use here, this was November 7th, 2008. We buy January 2014 tips. We receive a real yield of 3.74% plus whatever inflation is going to be, and just buying a bond that costs us $1 million. So at the same time, we short the February 2014 Treasuries, we pay 2.56%. When you short the bond, you get in the $1 million. So net, the swap doesn't cost anything, so the trade costs us zero. We lock in, so that here we don't know what our inflation payments are going to be, but we can lock them in by exchanging the inflation index for a fixed rate. So we lock in 1.36. So just very simply, we take in a little more than 5%, we pay out 2.5%. So that's really the whole thing. We make this agreement, we buy the tips, lock in our inflation, take in 5%, and this is in 2008, so we've locked it into 2014. So we effectively have agreements to take in 5%, pay out 2.5%, and that's the end of that. And so the cost is zero, and you set up an annual revenue stream of 2.5%. So,
so a couple questions just about how tips work. How do they actually work in paying inflation? Like the coupon the same, and the inflation accumulates up, so you get it's sort of paid cumulatively when the bond matures, or do the coupons grow every period? How does that
so
work?
coupons grow every period.
Yeah.
So you have, let's just say it's a 1.5%, or this one happened to be a 2% coupon.
Okay.
So they pay you 2%, but the corpus, so rather than maturing at a price of 100, let's say they're issued at 100, they mature at whatever inflation adjusted amount is. So there's some linkers now that are quite old, 20 years, where the corpus has grown over 250.
Yeah.
So depending on the bond, but so let's say on this one, I don't know what the corpus is, but let's say corpus has grown to 150. So you get 150 at the end, and each coupon is that corpus, the notional growth times the coupon. So let's say a current coupon would be 2% times 150 notional. Does that make sense?
Yeah.
So in the sense that you're getting compensated for inflation with each coupon period, and then they pay you at the end to compensate for inflation. So it really it works out to be whatever real yield you take in, and then all the inflation parts wash out.
What happens if deflation happens?
Well, that is an interesting, and the academics were very good. This is a bit of minutia of these bonds. If deflation happens, it's a home run for us, because these things have a floor. They won't go. So when they get issued at 100, and then some of the old ones, as I mentioned, some linkers have grown like to 250. But let's say you have deflation out of the gate, it's floored at 100. So our bond doesn't go down in value. This thing here will go down in value. So we have a free option there, because we're receiving that fixed rate. And if we're paying the inflation index and it's a negative inflation, so if you pay a negative rate, you're receiving a rate. So this is a free option. Now, that hasn't worked yet, but in theory, you have a free option embedded in there. On top of this whole arbitrage, you have that little quirk.
I have a question. Have you thought about it? Is there a way to monetize that option?
You could sell some inflation floors.
Yeah.
Now, the one thing that the bonds that we dealt with are old enough that they had grown well above their floor, so we would really need big deflation.
Yeah.
So the deflation floors had very little value, but just kind of in a theoretical sense, it's an added bonus if the world were to implode.
How much depth is in the trade? Can you do zillions of dollars?
Well, it depends on the time. So I'm going to go into that more a couple slides. But in 2008, the whole world was imploding, and we could have done infinite. And now we couldn't do infinite because the world is stabilized, and there's buyers for tips out there. But in 2008, everybody. How about I'll just forward to here's the historical yields on this question. You can see the black line is tips real yield plus locking in inflation. The blue line is the Treasury yield. So you can see historically tips yielded a little bit more than Treasuries. That's partly because they're a tax disaster in the U.S. They're also kind of complicated in the sense, the thing that we talked about with the corpus growing, so mom and pops aren't so excited about them. So complicated bonds always trade slightly cheaper than normal Treasuries and yields and such. So they were a little bit mispriced, but wasn't a big deal. But so here, Lehman goes bankrupt. And right at this point, and the thing goes crazy. It goes up to 250 basis points mispriced, which is the slide I just showed you. But so on your question of how many tips, Lehman held a lot of tips as collateral. But when the world implodes, everyone's like, what's the first reaction? We got to buy the safest thing. What's the safest thing? U.S. Treasuries. So the yield on U.S. Treasuries plunge. The yield on tips goes to the moon. And even though they're the same thing, you just need an inflation swap to make them identical products. But the world doesn't think that way. They're just like, hey, we need risk-free assets. What's a risk-free asset? Treasuries. And dump everything else. And so on your question, in 2008, we could have done infinite because everybody was just loading any tips that they had, just get rid of them. And so 2008, we could do infinite. We couldn't do infinite currently. But
the depth on the inflation swap is big.
That is a little bit less so. You got to have a counterparty and a bank to trade with you. But again, you can do, in U.S. inflation swaps, you could do significant, so as in billions. We had no constraint in terms of our size. Now, just one aside, you mentioned that our fund is $475 million. We couldn't grow, and we don't want to grow, but we couldn't grow to be AHL and be $23 billion because for us to kind of make the returns that we do, we have leverage. So if we had $23 billion, we just couldn't. We trade in New Zealand. New Zealand doesn't have an infinite government bonds. So that's one of the reasons we try and stay smaller. We were closed for most of our history. We're open now because we have very good opportunities. But so on your question, on the direct answer on this, we could do close to infinite in the U.S. But so one of the things too is that we're not particularly good at saying this is the moment to get into the trade. Our specialty is just saying, okay, these are mispriced, and we're going to get in. And just going back to this one, a lot of times I get the question of, oh, well, what's going to be the trigger? What's going to be the catalyst that all of a sudden these bonds will be correctly priced? And you know what? We're not really looking for that. We really don't care. I know AHL, let's say the turnover, I think average trade is on for 8 days. Our trades are on for years. So if we can take in 5% payout 2.5 for 6 years, that's good. We don't need anything subsequent. If we can, right now we have about 10 to 20 trades around the world. If we can find, revenue streams like this of 10 to 20 trades around the world in a backwards way, we almost don't want them to be correctly priced. We would make money quicker, but in terms of a Sharpe ratio, if we can just have a permanent situation where one's paying 5, the other's paying 2.5, we can just slowly take in the money every day. That's a fantastic spot for us. So we're really not looking for quick corrections. They never really occur anyways. The things that we get into take years to sort themselves out.
And you try to leverage them up to get more out of the year?
Yeah, that is correct. Yes. So, so we have a revenue stream of 2.5%. So we'll do multiples of our asset base with this trade. But so just on the.
I'm sorry, I've never worked with these derivatives. So what is this CPURMSA inflation index? I mean, how it is constructed, how it works, because I've never heard about it.
Yeah, so that's just the U.S. government code for it. So it stands for CPI. I got to remember all the words to it. But so it's
I wouldn't go so deeply into the notation. I would go more into the definition, really, how it is constructed.
Sure. So basically, it's the inflation basket, and NSA stands for non-seasonally adjusted. So it's just the inflation basket for the U.S. So let's say when you see in the newspaper U.S. inflation is 1.2%, that's the number that they're reporting. They just take, you have an index of this basket of stuff costs $100 or whatever, and next year that basket of stuff costs 101.20.
Okay, so this number changes how often?
Once a month. They'll come out and they'll just say, here's the index, and so your tips will grow by that index, and in theory, your costs of being an American, living as an American, should grow by that.
So if you buy this bond or does your inflation change there, because the coupon is somehow linked to inflation, isn't it?
Mm-hmm.
So it's changing when you are pricing it. So it's changing according to inflation, right?
That is correct.
So we are probably using some kind of discounted curve, which is somehow adjusted for the inflation and for the credit rating of US, or how this works exactly?
No, I think you're making it a little too complicated. So here we get this fixed rate, which it just pays out, a real rate, which is a fixed rate, and then we receive inflation. The bond will also pay us whatever that index comes out for that month. It'll pay us that much. So there's 6 months quibbling. Now, just when you say, the only part I'm quibbling with is you're saying discounting and such. Here, this is the exact opposite of this inflation. So here we're receiving inflation on the bond, here we're paying inflation, and so the whole thing nets out to zero. So the only part I'm quibbling with is when you were saying discounting, I'm saying that this part just washes out.
Okay, so what would happen if the US go bankrupt?
But if the US goes bankrupt, both of these go to zero.
Okay.
So that was one of the academics, I highlight this in terms of basis points. The academics highlighted it in terms of price. So they said this bond trades at 77, this bond trades at 100. The US goes bankrupt, they both go to zero. So we shorted at 100, it goes to zero, we make $100. We bought this one at 77, goes to zero, we lose 77, so we monetize the 23.
Yeah, thank you.
The swap you're taking with a counterparty that is risky, right?
Yeah, now on that, remember, so let's say that you and I bet on Man U Chelsea. So let's say on day one, we say, okay, £10, we're going to bet on Man U Chelsea. On day one, before they play that game, you don't have risk to me and I don't have risk to you because the present value of that is zero.
But what if the inflation goes lower?
Correct. So here we have received a fixed rate. If inflation goes lower, now you have risk to me because my trade is starting to win. So you have risk to me. So let's say that you're the bank. So I trade with Barclays Bank, and the inflation rate goes lower. Now Barclays Bank has risk to me, and if it goes the other way, if inflation rates go higher, I have risk to Barclays Bank. So you are correct. There's a situation where you have risk to the counterparty. That is a factor. But the only part I'm saying is at the very beginning, the risk is zero. It washes.
Yeah, but okay, it's the other way around. But then you have a risky counterparty, right? And do you think that the money you are making is just pricing for this risk potentially?
I say it once more, that the money we're making.
Well, so it's not entirely arbitrage, is it?
Well, so I'm saying, let's say that you're saying in the situation where inflation rates go up, I have risk to the bank. Yeah. So now I can extract money from the bank. So if we're up money, I can say, all right, post collateral with me. Now, so in the end, yes, you have risk to the bank in the sense that, let's say you don't pull it out quick enough and the bank goes bust. In that situation, you would have risk to the bank. But as long as we're on top of it, we can minimize that risk. But we can't capture this trade without, so I mean, one of the next slides here is the risk to the trade is, the mark-to-market risk, as in, is the bank going to be there in the end? So we need a bank in order to capture this trade, to do this part, the inflation swap. The only part I'm saying, when you, at the beginning, we don't know which way the risk is going to be. So kind of the present value of that risk is zero in the sense it could be them to me, it could be me to them.
So I was just wondering that it became so profitable at the moment when the bank actually collapsed with its Lumens, which was kind of
Yeah. So the way so let's say we didn't trade with Lehman because we felt that we didn't trade with the investment banks. So we didn't trade with Bear, Revco, Lehman. All those worked fine because Bear and Revco, they were kind of weak counterparties anyways. Goldman, though, we don't trade with Goldman for the same reason. Now that kind of hurts because they are a good counterparty. But so on the Lehman situation, if we had traded with them, in theory, we should be every time, and I would like to think that we do this, that when we're up on a trade, that we extract money from them, the variation margin. So let's just hop to this screen. So on mark-to-market risk, if we're down, we have to send them collateral. If they're down, they have to send us collateral to minimize this counterparty risk. So if you're not doing it perfect, you can end up in a messy situation. If you're asleep at the wheel and you leave $100 million with them and they go bust, you're out of luck.
Basically, the stuff that's at risk is like 1 month of inflation, because the next, because as it were, your guy's going to go bankrupt just as they should have posted you some margin. Basically.
Why do you say 1 month? The only part I don't understand.
Well, they'll do the posting of the margin every month as the new inflation.
No. So pardon me. Posting of margin is every day.
Okay.
So it's like, that's something we look at each day.
So are you going to lose? You'll just lose 1 day of the margin if the guy gets bankrupt. That's your point.
If your trade moves, on that 1 day. Now remember, it can move for you, it can move against you. So, but yes. So the worst situation is it runs way for us. We're up a ton of money, and we didn't extract that money from that counterparty. Now, along that thing, just on a general fund idea, we have a prime broker that holds our assets, and Barclays is that prime broker. So we did a good job in the sense that Barclays was the only one that didn't take government money. But on your point, we do have risk to Barclays. Had we not chosen a good bank, or had Barclays gone bust, it would have been a bad situation. So that is a risk to running any fund. You can try and set up segregated accounts. Segregated accounts are kind of a weird concept. The idea behind them is that if the bank goes bust, they still pay you off. As to whether they work, you end up kind of in a legal morass. But there is that risk in the end. You need someone to pay you off.
So was Barclays your prime broker before you put on this trade?
Yeah, the whole way,
So
all 10 years.
When you were doing this trade, was there no thought of like, well, we'd like to do this trade, but all the banks are so risky right now, like that we may not be able to do it? Or you were just fine using that one prime broker?
Well, remember though that the banks being risky, it's possible that we're going to be down on the trade. So that was what I was just going to start talking about. What happened
at
here
this point is small.
is that we got in at 125 basis points mispriced. and we got run over. You know, I thought looking at the trade, hey, we take in 4% payout, 275. That's an arbitrage. You know, till 2014, it's a great deal. And little did I know it was going to be a much greater deal. You know, the thing went nuts. So our 2008 was terrible. We were down 37%. And it was all our losses were September 15, which was when Lehman went bust, to October 31. Those are the toughest 45 days of my life. It was unbelievable. So, you know, this was one of our trades, but all our trades went crazy like this.
Another question, or a couple. I'll ask the other one first. Do you not find there's much like value in having like diversified prime brokers, or why do you just have one?
There is some value in that. One thing, I guess I thought Barclays was pretty good. We're looking at like Deutsche Bank now. So yes, there is value in that. The other thing, these segregated accounts, since AHL, you know, there's benefits to being huge and there's detractions, but AHL can go to a bank and say, hey, I want segregated accounts, I want all these bells and whistles. For us, you know, we're a $475 million fund, we really can't ram through so much. But yes, that clearly would be an improvement to the fund.
And then the other question is, how big was this relative to all the other trades in your portfolio?
It was about the biggest trade we had, because it's, you know, as the academics wrote, it's the largest arbitrage ever. It was the best trade we had.
So was it like, what's large, like half?
So I'm going to say like 10-15%.
Okay.
So in general, we have 10 to 20 trades around the world. So just, let's say divide by 15, that's going to be 6-7% per trade. You know, this one was probably twice that.
And that's 45 days. Do you think of even going in even more at the high level, or?
Well, so yes, in general, we add trades as they lose and we remove trades as they win. The one thing that happened, we were losing money so fast in those 45 days, the fund was shrinking. So even though we didn't remove, but the fund as a portion of the trade became a bigger portion of our fund because the fund was shrinking due to the losses. So we did remove other trades that weren't as appealing as this one, and that was because we look at everything in terms of Sharpe ratios. How good is the opportunity? How volatile is that opportunity? The big mistake that I made in 2008, or that the only time we've ever had to remove trades was 2008, is because the volatility was much worse than I ever anticipated. It's you know, the trade was, I never lost faith in the trade. I said this, you know, it's all very clear, easy. So it was always a great trade. But the big thing was that we were wrong on the volatility. And so as a result, Sharpe ratio wasn't nearly as good as I'd hoped. And from that, we reduced the size of some of our trades.
Because relative value, you're locking in something that's going to give you value over 5-10 years. Do you find your investors are more patient? Or do they still want capital out?
So let's so the risk that we bear, so one of the big ones is investor risk. Will our investors stick it out with us? So we are very weak at marketing. Because the best time to invest in fixed income relative value is when the world's imploding. And that's exactly when no one wants to invest. So just to give you a little history, I worked at a fund in the 90s which had huge returns at fixed income arb. We were making a ton of money. Then Paloma is a bigger fund here in London, and asked me to come join them, trying to improve their fixed income in 1998. So I joined January 1998. Long-term capital goes under in the fall of 1998. I thought that, hey, this is my chance. Great opportunities. Long-term capital wipes out all the competition, leaves awesome opportunities. I thought, this is my chance. I'm going to go out and I'm going to launch my fund. I'll have a presentation like this showing people these arbitrage. They'll trip over themselves trying to get into my fund. I went 2 years, no income, no nothing. I was living out of a walk-in closet using New York Public Library, Bloomberg. It was tough. And so for 2 years, I put my own money in the fund. I had excellent returns. But I would go to meetings and do my shtick, and I'd say, hey, you know, we have these great trades, and they'd be like, well, how many Nobel Prize winners do you have? I don't have any. And you know what? These guys, long-term capital, doing the exact same thing you're doing, just lost $4 billion. You know, why should we invest in you? So people get scared. You know, you look at this trade, and you're like, wow, that's obvious. Why doesn't everyone do that? But the reason is because people get scared and they just panic. And so now the whole cycle has come again. Lehman goes bust, creates this anomaly, and by that point, I had 8 years of track record, you know, doing nearly 20% a year, and I still couldn't raise any money.
But you talked about during this terrible 40 days, 45 days, your margin calls were going up and up and up and up. So you were on the way to long term.
Exactly.
Right?
Yes.
You were, you know, if it hadn't gone round,
if
the opportunity had become bigger and bigger and bigger and bigger, it would eventually have bankrupted you.
Yes. So that's fixed income arbitrage is most famous for going bankrupt. You know, so it's all our competition got wiped out as well. One of the reasons that I think we survived, I don't really know other hedge funds, so I'm not positive as to why we survived and they didn't. We hold 40 to 50% of the fund just on the side, government bonds, cash, doing nothing. And for the first 7 years of the fund where everything went peachy keen and it just went straight up, we just collected coupons. There was no use for that stash of collateral. But then when 2008 occurred, we're down 37%. We're able to take from that pile sitting over on the side and just meet all the margin calls. But you're right, it's a tough game. As soon as you begin with any leverage, you can be the next long-term capital. So here's, the point that I'm trying to make. Long-term capital, everyone in the press, portrays them as a bunch of buffoons or whatever, which in the sense that they lost all the money is true, but they weren't wrong on a single trade. Every one of those fixed income trades they were right on. Barnegat began from the remnants of that disaster. I went out and I put on most of the trades that they blew up on in 1998, 1999. They were right on every one of them, but they just weren't around to collect the money. So that's we get in at 125, and I thought that was a great deal. And little did I know it goes to 250. You have to be around in 2000. We know taking in 5, paying out 2.5. If we're here in 2014, we know we'll have made money because taking in 5, paying out 2.5, that's obvious. But the question is, are you there in 2014? So the big ways that we're not there is, one, do we have enough collateral, like you're pointing out? Do we have enough to meet every margin call of anything that can ever happen? Do we have investors that are going to tough it out? Like, you look at it now and you're like, wow, that was an obvious trade. Investors don't think that way. They're terrified. And so I started to point out how bad we are at marketing, because all our marketing meetings, so like just compared to AHL, those guys come in and they 20-year track record and all, they say AHL is great. My marketing meetings are the opposite. I'm like, listen, Barnegat is best when the world implodes, and we're going to take a bath at some time over the next 10 years. Are you prepared to take that beating? And most people are just like, oh, no, and that's the end. So it's really, our marketing meetings are just telling them, they just open with the bad stuff. We have a dumpy office. We don't have anything fancy. There's only 6 of us at the fund. We're a much smaller fund that way. No fancy office, no mahogany walls, nothing. And, they come in, they're shocked by the office, and then I hit them with more bad stuff. But if they're still sitting there, that's the investor we want. So 81% of our investors have been with us since 2001. So we're very weak at marketing, but we've done very well on being very picky as to who we allow in the fund. And just one other anecdote, we had a big French insurance company come to us in 2007. So we put up big numbers for 7 years, everything's going fine. But when the world is efficient, we don't have as many things to do. So we gave back money 3 separate times. We forced it back to investors from 2005 to 2007. So a French insurance company calls, says, hey, I want in Barnegat, all that stuff. I understand the risk. And I say, no, we're not letting anyone in. Not only are we not letting it in, we're giving it back. So a half hour, he yells at me straight for a half hour. The whole phone call, just him yelling. So I was like, at the end, I don't know what to say. But I tell him, at some point, the world's going to implode. Long-term went under. At some point in the next 10 years, the world's going to implode. We're going to take a bath, and I'll let you in for all you ever wanted. So 2008 occurs. We take our beating. And I call him up because it's a great time to invest. We have this opportunity where we take in 5, pay out 2.5. Very obvious stuff. And he's like, no, I'm scared. And he wouldn't go for it. And then that guy had the nerve. He calls. So 2009, we're up 132%. On all the exact same trades we took the bath on, but we just, they snapped back. And he's like, okay, now I'm ready. And I was like, no, there's no way I'm letting you in the fund. We need that stable investor. We need someone who's going to stick around. And then the other thing is, to do the trade, you need to borrow and lend the bond. So we need the repo market to survive. One of the things that, like the first acronym that the Fed came out with was TSLF in the crisis, which is Treasury Security Lending Facility. So they were very adamant making sure the repo market had to survive. So that isn't such a risk, but I mean, just in theory, we need to borrow and lend in order to capture that trade.
That's another question. You said that you look at Sharpe ratios a lot every term. We look at Sharpe ratios a lot. The thing when we do it, it makes a lot of sense. But in what you do, it doesn't make any sense.
Yeah, it's a subjective
because
decision.
Well, yours are like, your returns are like sort of biased to having low vol. You just have the extreme tail risk that you implode. So the Sharpe ratios doesn't really tell you anything.
Yes,
Like,
that
about
is
your risk.
that is all correct.
Like, you know what your return is going to be. You just don't know whether you'll get it.
Yes, that is all correct. I don't have an elegant solution for that problem. It's a subjective decision. It's a difficult, and this is the kind of thing that we run into in all the marketing meetings. The fixed income ARB has this big tail risk. It blows up and it blows up nasty. It is all true.
So do you not look at any ways to maybe like get your best return minimizing your blow-up risk?
Well, we try to. So negatively correlated trades.
Yeah.
You know, if we can find something that's negatively correlated to that, that is obviously very good. Increases the return, decreases the vol. We have this big. In the end, you're going to need cash to meet margin calls. So we're holding this 40 to 50% of the fund. You know, I mentioned the big error I made. I never thought the fund could get as volatile. I never thought the fund could lose 37% due to the size of the trades we had. So that 40 to 50% of cash and government bonds, in the end, you know, sitting there to meet the margin calls, I think that helped.
Yeah.
Now, one thing that I receive a beating on from prospective investors, they all want me to buy tail risk options. So just going back to long term, the tail risk option that was a home run when long term went under is swap spreads. So swap spreads are a government bond compared to LIBOR credit. So if you bought a government bond and paid on LIBOR when long term went under, that was a home run because everyone raced into government bonds. Just like here, you know, so if you buy the Treasury compared to LIBOR, that was a great trade when long term goes under. So so for 7 years I received beatings on, you know, why don't you have swap spread tail risk kind of protection? I think in that, the tail risk it's a brilliant marketing story. There's no question, marketing wise it's genius. But in terms of reality, I don't think it works so well because when Lehman went under, everybody races into those swap spreads, so it worked for like 2 weeks, and then government bonds got crushed. Government bonds now trade at a higher yield than LIBOR out past 10 years in most countries. Even good countries like Germany, government bonds will yield more than LIBOR will out towards the 30-year. So that tail risk hedging idea, you'd have been out of business. Now, the beating I receive now is, why don't you buy VIX? So VIX is the stock index volatility. And because, you know, when Lehman went under, the VIX went to the moon. So people now say, you should buy VIX as your tail risk protection. So in the end, we don't buy any of those tail risks. Just because I think everyone's always fighting the last battle. And as a result, that tail risk is artificially bid up and a net loser. But marketing-wise, it's pure gold.
Do you know that other funds do that a lot?
Oh, yeah.
Tail risk stuff?
See, that's the thing. So just as an aside, so me coming out of school or like trying to start my own fund, I thought, you know what, 100% of the battle is finding these trades. If I can find one of these trades and present, you know, and I thought that as recently as 1998. You know, I left the fund I was at. I thought I could go out and people would trip over themselves getting into my fund. You know, but it just doesn't work that way. So a huge portion of the battle is fundraising, finding investors, stable investors. You know, so on your question of do other funds do that? Yes, they do, because you can get investors that way. It is marketing genius.
So the 3 legs of your trade, and I would think that tips was the one that was really badly mispriced in this. I mean, the inflation, probably in hindsight, will turn out to be not so bad. Maybe 1%, more or less, over 5 years. You know, it was really low, but you know, people probably wouldn't believe. And I could believe no one wanted to go to 0.5% or anything back then. But I mean, why did tips get to this crazy spread? I mean, you know, a lot of macro guys like to do this plot, you know, where you look at the difference of the two, and you know, people say, well, huge negative, negative inflation expectations in this kind of short period. You know, I mean, totally out of line with anything, certainly in the tips data. Why was it just attention? People just forgot about tips, or
I would say that's some of it. Now, because the tough thing to convey is panic. So one, Lehman went bust and they owned a zillion tips that they posted as collateral. So all that comes on the market. So that hurts them to start with. But you forget, like now, you know, we're 2 years after and things have survived. But you forget in 2008, people were like, you know, is anything going to survive? You know, that is the whole financial system going to implode? So they just sell anything that they can. You know, we had a whole bunch of trades like this. You know, this is kind of the most obvious one, and it was written up in the FT. But people just aren't. It's hard to convey panic. But you know what? I just think that people, they're like, get me out. I need cash. I want cash. You're right that the tips at 374. You know, that's silly. 374 plus inflation. You look at that now. You're like, that's stupid. But
I mean, you don't even need a third leg there, do you?
Well,
I mean, if you just took those first 2 legs and forgot about the third leg there, I mean, if you get incredible deflation because of this thing, I mean, that's the only kind of weird case.
Well, that's what happened initially. Inflation traded 10-year inflation traded negative on these inflation swaps in the crisis. So on the question of Sharpe ratios, yeah, our Sharpe ratio calculation is kind of a difficult one, but clearly, if you hedge yourself out, your volatility goes down. So let's say if you have a 30-year bond unhedged, I think that I'm going to say it's like 20 times if you're short another 30-year bond against it. I believe the ratio is 20 to 1. So I guess I would say it's easy to say that now because we knew how it played out, but that's really
the
not.
floors actually kind of give you this kind of option, though. I mean, if you had crazy deflation.
Well, remember, if we have crazy deflation,
That's good for
drops
you.
to the floor, but we don't make any money here, and we're short this bond, and that yield.
Well, you're not making money on the swap, right? If you get great deflation, you're getting.
Well,
paid,
I thought
right?
you were saying just doing two pieces.
Oh, right, yeah.
So yeah, if you just do two pieces, we have deflation, we lose it. But so the net of it all is we hedge everything out because 50 different things can happen. We know this package is going to make money. I don't know why all of our competitors went bust. So Long Term went bust a while back. Then he got reincarnated. JWM went bust in 2008. Citadel in big trouble. Didn't go bust, but shrunk greatly. Park Central, which was Ross Perot's hedge fund, $1 billion bust. JP Morgan Prop, $1 billion bust. Endeavor, $1 billion bust. So I don't know why they went bust and what went wrong, but I suspect one of the ways is that they're like, you know what, that inflation, we can leave that part out. This is too juicy. I think you're going down that road for trouble. But I don't know if that was the one they did wrong. I don't know.
The thing is, do you know what happened with gilts in the UK? You got the same type of thing. Do you actually know? I just haven't seen. Was it the same story or was it a different story?
Well, not as bad as this one. It's kind of weird that the linkers trade better in the UK than they do in the US. I don't know why. If the UK is just more used to them.
With a longer history, right?
Yeah, I think that helps some. So it helps to being more efficiently priced. So yeah, gilts weren't as wacky as this. But on that subject, like quantitative easing by the Bank of England, awesome. When I think just as a short note, so we make our money. The broad idea is non-economic decisions. So this one is a panic. The world panics. Another non-economic decision is Bank of England coming in and say, we're going to buy 25% of all outstanding gilts, and we're just going to buy them between 5 years and 25 years. We're not going to buy linkers. And UK Treasury at the same time, huge deficit, huge debt. We're going to sell anything you'll take. And so they issue between 0 and 50 years. They issue linkers, gilts. So relative value, that's a home run. So that paid us a lot. Did you have a question you want to keep going?
Oh yeah. So do you factor in time? It sounds like you don't try to time your trade at all. So that.
Well, we try. I'm just saying we're bad.
But it sounds like from what I've read, when LTCM was seemed like it was going to go down, people actually put on, they shorted those positions, even though the spreads just widened even more. And they maybe the spreads went that far because people were just waiting for an even juicier deal.
That is all correct, yes. And don't underestimate the nastiness of the competition or of Wall Street. When Long Term was going under, as silly as it sounds, you're like, who's going to pay a revenue stream of 2.5% for nothing? There's a lot of people who do that because they know if you can just push a little harder, if you can get them to cough it up, so let's just for example, let's say Long Term went bust. They've gone bust 10 years earlier, but let's say it's 2% mispriced. If you keep pushing on it, and let's say you push it out to 2.5 mispriced, as soon as you can get Long Term to cough it up, you get that position in. So if you start selling at 210, 220, causing them pain, and the instant they cough it up, you take it back in and you cover your position at 250, you're in a great. So there's no shortage of people out there with nasty incentives doing that. But again, to do that, you need to be in a spot with a lot of market information. So that's generally the banks, the prop desks, that kind of thing, who are in that business. Because they know, who's reboing what, how scared are they. And so there's no shortage of those people.
Similar to the last question. In 2008, were there lots of trades like this across different countries, or was it strictly a U.S.
Yes,
thing?
2008 was our best opportunities ever.
Yeah.
It was a great time. But again, we were able to raise money from our current investors, but no new investors. But yes, so there was a lot of great stuff out there. But again,
Like where in particular?
well, so QE2 was that was March of 2009.
Yeah.
But Japan had all sorts of problems. Basically, every country. Australia had interest rates trade negative. As nutty as that sounds, so there was no shortage of problems out there. So it was a great time for us. But you need investors you know, the big risk is you got to have investors who are going to stick it out. And we were fortunate that we did. But and just to give you an example, kind of not to, you know, poke Man in the eye. You know, the one investor we had that bailed out was Man. Man sold at the worst point. They were one of the people paying 2.5% revenue stream. But the thing is that MGS, which was the part of Man that invested in us, you know, they had redemption. There's nothing they could do. When you get redemptions in, you know, that was it. They had to redeem from us. So it's a very difficult situation. It's easy to sit here now and say, you know, stick it out. But when you're getting redemptions into Man, Man's got to get the money from somewhere. They have to get it from their investors. And so that was the end of it.
Well, I'm just aware we've been asking you lots of questions. You've got a few minutes left if you want to wrap up cleanly.
So I guess just so these are the risks, you know, so half the battle is finding the trade, but the other half the battle is being here in 2014. That's the part, like when the FT called and they said, oh, what about this trade? I said, oh, it's very well done, everything's perfect. But you have to remember that you got to be here in 2014 to collect the money. And so anyway, so here's our returns. You can see that it was brutal, you know, the beating here. But basically we've done like 18% a year, and just the ending point at the end of 2008 was horrible for us, but it made for a terrible 2008, but then a very low starting point in 2009. So if you take these two together, the net return on those is like 20% a year, which is consistent with the other stuff. But you can see too that our stuff is uncorrelated to the other big investment indices.
Also, just saw this thing about the repo market being so important to you. Very technical question here. Do you time your terms of repo? Do you try to time them to the approximate duration of the trade?
In a perfect world, I wish we could repo to 2014, because then we'd never have to see the trade again. The repo market only really exists out to 6 months. So given that 6 months is the closest maturity to 2014, that we repo as long as we possibly can. And that's rare. Most people repo like overnight, very short. It'd be great if repo market was longer, but 6 months is as long as we can go. All right.
Just as a quick comment on the performance you put up there, just to illustrate the difference in what Bob's doing compared to what AHL does. 2008 was a fantastic year for AHL. It was the best I can actually remember in my career at AHL. We made 33%. 2009 was awful for us. We lost 18%. So this is very different type of trading. It's trying to capitalise on different things, and you can see it very starkly in the returns over the last 2 years.
That was my initial marketing shtick to Man. Say, hey, when the world's imploding, Man steps on the gas and, you know, keeps pushing it. And whereas we get out there and we say, okay, this is nuts, it's going to come back, or whatever the relationship is. And I thought we'd be negatively correlated. It's turned out we're uncorrelated, that it's not negatively correlated. But that was my initial marketing shtick to Man.
Are there any last questions? Okay, I'd like to thank Bob very much for this very stimulating talk.